Keith, it is great to see you because we got a lot of news here, Keith. We had a Trump social media post talking about a framework for a deal with NATO over Greenland. What that means exactly, Keith, not sure. Framework of a deal is, of course, not an actual deal. But importantly, Trump does call off the new tariff threat. Markets love it. I see green everywhere. What do you make of it, Keith?
Yeah, we like it. I mean, obviously, the market's been nervous recently as the geopolitical risks have risen. That's why we saw sell-off yesterday. I think today is just kind of recouping what we lost yesterday. We as investors are looking at company fundamentals. So all the stuff that we're hearing on these geopolitical tensions, one way or the other, what's going to happen with Greenland, what's going to happen with EU tariffs, I think that's a lot of bit of noise. And what we want to look at is company fundamentals. And right now, we're in Q4 earnings season has started, and it looks fairly decent right now.
But let me ask you, Keith, I mean, how do you distinguish? You're seeing these headlines. How do you distinguish as an investor between, okay, this is noise versus, okay, something fundamental and structural has shifted?
Yeah, we look at past, kind of a guide, look at history. I mean, if you look at last year when the tariffs got first announced, April 2nd, Liberation Day, markets sold off pretty aggressively, down 20%. Again, what we were doing is looking at the company fundamentals. We think that was a buying opportunity. It certainly proved to be because the S&P then rolls the next 40% on those lows. Now we're starting to get noise again, whether it's Venezuela, EU tariffs, Greenland. We don't know what's going to happen there. I don't think anybody really knows what's going to happen. And we don't like to invest by news flow. We want to see some corporate fundamental actions. What are companies doing? How are they changing their policy? Do on some concrete evidence, not on these kind of hypotheticals. Who knows what this potential outline agreement is going to be? And again, I think that's what we want to focus on, not just the news flow. And if something does fundamentally change on the news front, we will change our portfolio positioning.
So to your point, Keith, and listen, I agree. I think investors would rather focus more on earnings than headlines and geopolitics. On earnings, Keith, I guess big picture, what have you learned so far during this earnings season? And what are your expectations for profit growth in the year ahead, Keith?
Yeah, we've, last week was the kickoff with earnings season was generally the banks, and they were very healthy. And we had some credit card noise, but again, by policy, kind of potential 10% cap. So those were kind of a little bit noisy. But you had like the Morgan Stanleys of the world, Goldman Sachs, phenomenal. They said the economy is resilient. You've heard some reference to the consumer getting a little bit better. You still got this K-shaped economy. People are talking about the higher end doing better, the lower end not so well. But we have, these tax cuts that are going to get in place for this year. I think there's a better spot for that low end consumer. So I think that can help alleviate the pressure on that bottom end consumer, which will be a very healthy thing for the stock market as that cohort can participate in the markets as well.
How much good news do you think, Keith, though, is priced in with this sort of earnings picture you're outlining?
Oh, I think quite a bit. If you go back the last 3 years in the S&P, we're up 26%, 25%. Last year, 18%. So a lot of good things. But when you take a step back and look at all the things that are going forward still, the one thing I'll point out to the two things would be earnings growth. This year is expected to be 14%. That's an eye-popping number. If you go back the last, couple of decades, if you can get that 5 to 7, that's kind of the sweet spot for earnings growth rate. That's a good, healthy backdrop. But we did 11% in 2000 or last year in 2025, excuse me. And if we're going to do 14%, that's an acceleration. GDP is accelerating. And lastly, unemployment's around 4.5%, 4.6%. That's still a very healthy number. And again, no one can spend like the U.S. consumer. If the U.S. consumer is working, they have money in their pocket, they will spend, which continues to drive this cycle.
Before we let you go, Keith, let's get to some picks, get to some opportunities. Amazon is a name you like. Why is that a winner in 2026, Keith?
Yeah, it was a laggard of the Mag 7 last year. I think it was the worst performer, actually. I think that's been the valuation is very reasonable. Last quarter at the end of the year or in October, it was a fantastic quarter. Stock popped, and now it's been selling it off. So they have two parts of their business. They have the technology side of the business, which is AWS, which is re-accelerating. And the one area that we like in general is consumer, and half of their business is consumer related. I think they're in a fantastic spot. Multiples are at decades low. I think they're going to re-accelerate. CapEx is behind them. I think this is a good stock to be owning going forward.
What about TJX, Keith? That one's up around 25% already over the past 12 months. Is that still a buy here?
Yeah, that's a buy. Valuation is not cheap, though. You pointed out right. This is one of the different story than Amazon, where Amazon's been a little bit of a laggard. TJ has been a market performer, if not better. Valuation's expensive, but it's a leader in the off-price retailer. So as the consumers are looking for deals, TJX Max is one of the stores that pop up to the top, and consumers will continue to spend there. Even if they get a little more healthy, they still want to find a deal, and that's what you can find at TJX.
Finally, Keith, here's a name we don't talk too much about on this show. Cintas hasn't done much over the past year. It's actually edging in the red here. What moves it higher, Keith, in 2026?
Yeah, all the things I talked about, earnings growth, GDP getting healthier, the consumer spending, more small jobs, small businesses. They're the uniform rental company, the facilities. So as the GDP gets better, you have more people working, you need more laundry done, you need more facilities serviced. And Cintas plays right into that. And again, that's been a laggard relative to some of these other names. But longer term, when you take a step back on this name, this is a compounder, some kind of name we want to be involved in right now.
Keith, great to have you on the show today. Thanks for your time and those picks.
Thank you.